All right, everyone. I'll get started. It's 7:03. So thanks for coming out to our webinar tonight by talking about all about private lending. I'll be going through this as a borrower, but also as a lender too, as we've had a lot of people that are interested in becoming lenders with interest rates going up. It's a good time to be lending, not borrowing. That's for sure. So let's talk a little bit about the table of contents and what are we talking about today. First, I'll start off with talking about the difference between A, B, and private lending. I'll talk about what private lending is, why you would go private, and then also talk about why be a B lend or a private lender. What are the risks? I'll go through some examples to give everyone an idea of what you can expect when lending on a private lending deal. I'll go through some examples so people can get a general sense of what you can expect on rates and fees in a private lending situation. I'll also talk about what a MIC is, a mortgage investment corporation, as that's another opportunity or way that you can invest in debt, and also comparing your options. So looking at investing in real estate and being a purchaser of real estate, holding equity, basically, buying stocks, and compare that to being a private lender. And there's a lot of differences between all of those. And then, of course, how you can get started. So let's go going. Oh, I pushed the wrong button here. It's going backwards, not forwards. There we go. Okay. All right. So what is private lending? Private lending is a number of different things, but it helps to understand what private lending is after you understand what an A lender is and what a B lender is. So when we say A lending, we're talking about banks, credit unions, and what we call non-bank lenders. So major non-bank lenders like First National or MCAP, those lenders are still A lenders because they lend out to AAA clients, and they have very low interest rates and competitive pricing. So that's typically where you're going to see the best rates, also the tightest underwriting policies. The lending is very client focused and moderately property focused. And so in general, the A lenders are usually looking more at the borrower themselves and less at the property itself. And so if you have a really strong borrower, yes, they do still want to lend on a good property, but they're not as picky about it as say a B lender or a private lender would be. If you get into the B side, or often called subprime, then you're going to be looking at interest rates that are usually a little bit higher. So usually bank rates plus 1 to 2%. And then you also have fees that are usually between 1 and 2% of the loan amount in total. And there's usually a little bit more flexibility with credit. So they'll be more flexible with credit, more flexible with somebody's income. In particular, B lenders, usually if you're self-employed, this is a really good place to go. A B lender would usually have a lot more flexibility with how they treat income. B lenders, for instance, would look at somebody that just started up a business 12 months ago, and they would look at 12 months of bank statements instead of the financial statements or the personal tax returns. So there's a lot more flexibility with income. They usually use slightly higher debt servicing ratios. On top of that, their credit requirements are often lower than major banks as well. So usually 600 or 620 is the cutoff with most major banks on the A side for credit. B lenders can go lower than that if the income and everything else checks out. And B lenders in general are a little bit more property focused now. So you're going to find that they're a little bit more lenient with the borrower, but a little bit more property focused. And then we move all the way down to private lending. This would be anybody that's a MIC, a mortgage investment corporation, or a private lender. This is usually where the rates are typically much higher, fees are much higher, and there's minimal client underwriting. So they look at the client a little bit, but they're mostly looking at the property itself. So slowly over time, if you go look at A lending, they're basically way over here on the client. They want AAA clients, and they're way over here. Well, I would say way over here, but they're somewhere in the middle on the property itself. You go to B lending, and there's a bit more focus on the property and a little less on the borrower. And you go private lending, and it's the opposite, where the one way to look at it is a private lender really focuses on what are they lending on and how much are they lending on it. And they look less at the borrower themselves. And so they almost assume that a default will happen and then just determine whether they're comfortable lending on that asset and whether they're comfortable foreclosing on that asset. Because they're lending to somebody that has a lower propensity to be able to pay for that mortgage than somebody that would be going to an A lender. And so, if you look at all of these and understand this, then you can understand a little bit on what an A deal looks like, what a B deal looks like, and what a C deal or a private deal looks like, and the nuances between all of them. So private deals can look be in many shapes or forms. Deposit loans are a common one. Sometimes a buyer is selling their home, and that's where their down payment or deposit for a new purchase is coming from, and they may need a short-term injection of cash to come up with a deposit on a purchase. They might be doing a flip. Properties that are very difficult to finance would be something that's torn down to the studs or in really, really bad shape. These can be great flipping opportunities because you're paying less for the property, and it means that you have more room to actually renovate it and make more money on the flip. But this can be a tricky situation to get bank financing. So those are often things that have to go through private lending. Development deals, if you're a developer or interested in doing development, this is something that's tightened up a lot over the last couple of years and really in the last 6 to 12 months. Anything that's pre-building permit, really hard to get financing on. And so you're finding that that banks are tightening up and pulling off. Private lenders are starting to do this a lot more. And even the private lenders are getting inundated with a lot of this. And so it's getting harder to fund these projects with them too. First and second mortgages, just a standard first or second mortgage where the borrower doesn't qualify with a major bank. These are the most commonly done private loans. And then, of course, short-term loans. And usually, most of the time when you're doing a private loan, you're usually trying to find an opportunity where the borrower is in the loan for a very short period of time. You don't want to be in a situation where the borrower has no way of being able to pay it back. And one of the things as a broker, what we're looking for is what's called the exit strategy. So what is the exit strategy to get out of this private lending and get into an A lender or a B lender, or just get the loan paid off in full? A flip is a really obvious exit strategy. The idea is to buy the property, do the renovations, flip and then sell it, and then pay off the loan. In some cases, if it's credit improving, then we know that, okay, if the client does this and this and this, the credit should be high enough to then be able to refinance. If it's income, then we can say, well, if the client just does this and this to their income, then they can refinance and restructure it. So we like to say that in general, a private loan is usually ideally a short-term loan. It's better for the borrower because you pay less in interest overall. It's better for the lender too because it lowers your risk. If the borrower is unable to make the payments and their financial position gets worse and worse and worse around this mortgage, then it makes it harder and harder in the future to foreclose and get your money back. And so in general, you're wanting to make sure that there's a clear exit strategy and a position where you can get your money back and get it back quickly. So a couple of different things to look at in general is comparing your first mortgage versus a second mortgage. So usually on a first mortgage, as of right now, you're usually getting pricing that's somewhere in the 8.49 to 11.99 range. Most stuff gets priced between 8.5 and about 10.5. So that's the standard that we're seeing. The fees are usually between 2 to 3% in total fees, and that's including the mortgage broker fee. So you'll find that normally the lender fee is anywhere from 1 to 2%, and then the broker fee is usually about 1%. Of course, if it's a really complicated deal or difficult, then sometimes the broker fee can be more than that, but most of the time they're about 1%. The loan to value, so the percentage of the property value that you're borrowing, most lenders cap it at 75%. There's a very small handful that will consider 80, but right now in today's climate, and especially over the last 12 months or so, they're few and far between. Not a lot of lenders like to go up to 80% financing right now. Usually the mortgages are constructed as interest only, which is nice. And so if you're borrowing money at a higher rate of return or higher cost, the fact that they're interest only can sometimes result in the payments being about the same as getting a standard mortgage, which is interesting. They're usually closed or open. In general, the lender will charge a higher fee if it's open, and they'll charge a lower fee if it's closed. And then normally most private loans are done as a 1-year term. Now, you look at second mortgages, a lot of these are the same. The major difference is that generally speaking, the rates are usually higher. Usually they're about 2% higher on average for the same loan to value, just because they're a second mortgage. And the difference here is that if there's a default, the first mortgage holder gets paid all of their money before the second mortgage holder gets any money back. And so if you have a first mortgage and there's a default and a foreclosure, then you get paid all the money that you're owed before the second holder gets anything back. And sometimes there can be nothing left for the second holder. And so typically this is where you want to know how big of a mortgage is in first position, and what is the overall loan to value between the first and the second mortgage to make sure that your risk is minimized. Second mortgages can have higher fees, anywhere from 2 to 5%. I've actually seen higher than that, but it's quite rare. In general, the smaller the loan amount, the higher the percentage the fee. And that's because for the lender, for the broker, it's the same amount of work to do a $50,000 second mortgage as it is to do a $500,000 second mortgage. So you'll find that in general, the fees as a percentage are bigger for smaller loans than they are for larger loans. The loan to value, again, up to 75 or 80. Again, it's tough to go over 75 right now, but a few lenders will consider it. We've had in certain periods of time, some lenders will consider up to 85, but it's pretty rare. And in today's climate, very, very rare that a lender would consider that. And the rest of the terms are all the same: interest only, close or open, and 1 year term. So it's really just a matter of the pricing and the risk tolerance that's a little bit different. You'll usually find that first mortgages are generally bigger, and the second mortgage is usually a lot smaller. So if the rates and fees are so high, why would you use a private lender? It's probably been because you've been declined by a bank. And so most people don't go out and they just don't usually assume, hey, I'm looking for a mortgage with a private lender. It's usually because they were declined by a bank. And so why are clients getting declined by banks? There's a lot of different reasons. One of the reasons that we see this come up sometimes is with really quick turnarounds. And so if you wrote an offer, and a lot of people were doing this before, but writing an offer subject free, so no financing clause in your offer, assuming that you would get a mortgage to the bank, and then got surprised by it, all of a sudden you have a really tight timing for closing window, and now you have to go find somebody that will give you the money. I've done a deal with a private lender before where we closed in 2 business days. So it is possible. It's crazy, but it is possible to turn around a private loan in a very short period of time if you need it. Sometimes if it's just an amazing real estate deal. So if you find a deal that's really, really good and you struggle to put together the deal in a way where you can get it with an A lender or a B lender, sometimes the deal is so good that it still makes sense to just buy it, and then maybe you flip it right away. Maybe you do some renovations to it or whatever. But in some cases, even if the cost of borrowing the money is more expensive than an A lender, maybe the deal is so good that it makes sense. So an example might be, let's say they're buying a property for $100,000 under market, and an A lender interest cost might be $20,000 a year. A private lender might be $40,000 a year, but you think you can flip it in a year. Well, either way, your profit margin is $20,000 less if you go through the private lender, but you still have a really big, thick margin there to work with. And so if you feel like your profit margin is still very good, then doing an amazing real estate deal, even if you have to go with a private lender, may still make sense. Again, usually you're going to find that that's something where it's more of a flip or another opportunity. Paying off higher interest and or payments, credit. So if you have credit card debts, lines of credit, all these other debts, there's 2 reasons that you do this. Number one is just to save on the interest costs, and the other thing is to save on the monthly payments. And in many cases, the interest cost might be similar. A second mortgage at 12% interest. If you're borrowing a lot of money at credit card debt, it could be 19%. If you're borrowing a lot of that money at line of credit interest, then it could be about the same. But you might find that your payments actually decrease because you're just making interest-only payments on the debt, which, depending on your debt load, could be a huge benefit for you. Another thing, too, is if you're paying off all these high-interest credit cards and other debts, you're also helping your credit score grow, too. And sometimes that's really important. If your credit score is already hurting and you're trying really hard to repair your credit so you can refinance and get it done with an A lender, you might end up staying in that position for a few years, and you might not be able to actually fix your situation. So sometimes what we advise is if your credit is hurting, one thing to look at is, can you get a private mortgage to pay off that debt, repair the credit much quicker, because now all that credit is improving and all that debt is wiped off your credit bureau. And it helps a lot with your credit improving very, very quickly. And so this can be a situation where I often say, it's a wound, put on a Band-Aid so you can actually heal it properly. And then when you're done, you can rip off the Band-Aid and it's all good underneath. Otherwise, you're just letting the wound fester, and maybe it never gets better. So it's something that really helps, and it can help with your monthly payments, but more importantly, in some cases, it helps with improving your credit score. And yeah, as I was just mentioning, just fixing your credit and trying to improve that is really important here. For you, those of you that are investors, sometimes getting this expensive debt can just be simply cheaper than getting a joint venture partner. So you might be in a situation where you need to, find a really good opportunity, you need to do the deal or want to do the deal, and you realize, oh man, I can't quite get bank financing, but the deal's so good that I really want to get the deal done somehow. Maybe I should bring in an investor. Well, sometimes you look at it, you realize, you know what? Even though the cost of borrowing is higher, it's still cheaper than bringing in an investor and giving them 50% of this awesome deal. So sometimes getting a private lender can be better for you than doing it through a joint venture partner. And Mark asks, are private loans or mortgages noted on your Equifax or TransUnion or other credit score reports? The answer is no. So these mortgages don't report on your personal credit bureau. Major bank mortgages do, but not private mortgages. And the last one here is just if you're in a bind. Sometimes people just get in a situation they didn't expect themselves to get into, where they need money quick, and private lending is often a solution, or perhaps even the only solution for some individuals. So the private mortgages is, if you have equity in your home, you can almost always get a private mortgage as long as it's in a good area and has a fair bit of equity in it. Now, one of the other things and benefits of working with a private lender is the flexibility. So there's a lot of things that private lenders can do to set up a deal to be a lot more flexible than say a bank. And one of the things we do a lot here is you can actually do a zero down deal with private lending. So just yesterday, I was talking to a client who's looking at buying a commercial space for themselves, but they don't have the down payment for the commercial space, and it doesn't look like they'll be able to get a commercial loan. One of the things we looked at was, well, you do have a home that has quite a bit of equity in it. You won't qualify to refinance it, but what we could do is we could get a commercial loan with a private lender that would be stretched over both the property that you're buying and over your home. So this is called an inter alia mortgage. And inter alia just means like a blanket mortgage or umbrella. But basically, it's a loan that's secured by multiple properties. And this allows you, in some cases, to do deals where you actually don't put any cash into the deal. So you can do a zero down. And interestingly enough, when we ran the numbers, the monthly payments for the private loan were not that far off of getting a major bank mortgage, because they're interest only. Even though they're a higher interest rate, it was interest only payments, whereas the bank mortgage for a commercial loan would be a rate that was about 2% less, but will be a 25-year amortization for commercial, which is quite common. So zero down and inter alias are really, really common and popular, and it's a good way of structuring things. No payments as well, which is really, really cool. So one of the things that you can do is you can structure loans so that if you're borrowing $500,000 and you don't want to make payments on it for a year, you could add all the payments for a year, let's say. You can add that to an interest reserve. And so the bank just collects their monthly payments off of the interest reserve. So you don't actually have to make a physical payment. So as long as there's enough equity where you can get a $550,000 or $560,000 loan on that property, you can structure a loan where there's actually no payments on it until the term or the interest reserve is expired and used up. And then if you do break the mortgage before all of the interest reserve has been used up, then it's just a credit and it reduces the loan amount back down. So sometimes that can be a really good idea, especially for people that are very stressed and worried about being able to afford the higher payments when they borrow all this money at a higher rate. Starting a business, very common. That example I was giving you earlier, where it's really hard to get a business loan and a bank loan for that new location that the client was looking at buying. Starting a business is a great way to also be leveraging and utilizing private lending. It's very difficult to get private lending, or I should say bank financing, for a new business. So a private lender could be a good fit, especially because if you're starting off your business or you have a new business, you probably don't have a very usable income the bank wants to use to calculate and qualify you for a mortgage. So a private lender could be the only option. Construction loans, a lot of banks are very tight on construction loans, and so construction can be a reason to use private. In fact, it's a very common way of private lenders being useful and relevant. And then, of course, lending to operating companies and holding companies. Sometimes this is a situation where it can be more difficult to sometimes get financing in operating companies or holding companies, in particular operating companies. And so this is something to consider as well. And I know, Michael, you're just mentioning always buying through a holding company, these private concepts generally apply in that case as well. And the answer is yes. These private lenders are quite flexible, usually on the company that is purchasing them. They're not as sticky as the banks where they say it needs to be a true holding company, or some banks say we don't lend to holding companies at all. So they're generally a lot more flexible with who the borrower is. And usually the borrower is the company. They still will want a personal guarantee though, like every time. So we've talked a lot about why you would be a borrower and what kind of circumstances you could be in order to require private lending and what the rates and fees would be. Let's talk about the other side now. Let's talk about being a lender. And the reason I'm bringing this up is that we found that as the interest rates have risen, we're actually in an interesting spot where the cost of borrowing money and the difficulty of getting a bank mortgage through a bank is more difficult. And on top of that, if the rate of return is higher to lend out money, we're finding that both the supply and the demand for private lending has increased at the same time. The supply, because more private investors saying, "Ooh, I can get 10% investing by being a lender instead of having to worry about buying real estate, buying a property, having negative or zero cash flow, not really sure if the market will appreciate short term or not, but I can get a higher rate of return by being a lender." So a lot more people are interested in that right now. And on the flip side, as a borrower, it's harder to get mortgages today. So we're finding there's a higher supply and demand. And because a higher quality borrower now doesn't qualify for these mortgages, we're finding that in general, as a private lender, it's not a bad time to be a lender because you can pick and choose the type of deals that look good to you. So a couple of things to look at and understand is that there's more safety when you're lending. So debt is always safer than equity. So if you lent money to a business, for instance, if you invested as an equity partner, then your money could go down to zero. If you invested in it as a debt partner, it's less likely that your money would go to zero, because what happens is if that company ever goes upside down, equity is always paid last and debt is always paid first. It's not unlike in real estate where if the property is sold, the debt is always paid first, and then whatever is left over, the equity is paid out after. So it's always safer to be in debt than it is to be in equity. Right now, especially, the returns are quite reasonable. If you're investing in debt right now, you're easily getting 8 to, if you really wanted to push the limits and go higher risk on it, some of our private investors do higher risk loans and get 15 or 16%. But I would say the vast majority, like 90% of our stuff, is somewhere between the 9% and the 12% range. That's pretty typical. And it's easier than buying real estate. It's much easier because you're not having to qualify for a mortgage, find the property, purchase it, and do all that. So it's a lot easier to do. It's more liquid than owning real estate. The biggest key here is just that usually if you're lending out your money for a 1-year term, then you are committing for at least the 1-year term out to the borrower. It's rare that we see this, but you are actually able in most cases to actually sell your debt to somebody else. And so if you lend money to a borrower and then you want to actually get out of it, you can usually just find somebody else that will replace you, and you can sell the debt to them. So that's an assignment of the loan. And in general, you're looking at better cash flow than owning the real estate too, because your return is all coming from cash flow. If you want to be a private lender and invest in private mortgages, generally speaking, the key is that if you're going to be the lender and you're just going to be the one lender on a deal, then you have to have enough cash that you can actually fund a loan all by yourself or with you and a few people. In general, if you only have, let's say, $50,000 available to lend, you won't find a lot of deals where the borrower needs only $50,000. And so these are situations where if you have less capital, somebody's investing in something like a MIC may make more sense, because you can invest often as little as $25,000 with MICs. And your money is put into a pool of funds that is then used to invest on properties. So as a lender, it's important to make sure that you're properly assessing the risk and doing some analysis. And so, private lending underwriting is very different than A and B lending. It's based more on the property, location, and type, and loan to value. And so the property is really the foundation for what you're lending on. That's a really important key. The exit strategy is really important as well. Knowing what is the story here? How are you going to get paid? How do we get out of this loan? And then last but not least, the borrower still does count for something. Understanding who the borrower is. The borrower doesn't determine the pricing and whatnot quite as much as the property itself does. And so you can see that the property here is generally the most important part of this. Yes, Marcos, this will be shared, so everybody that registered for the event will be sent a recorded version of this later. So probably sometime tomorrow. So one of the things that you're trying to do here is you're ideally trying to eliminate like if it's an A lender, they're usually trying to eliminate the risk of default, and they have an in-depth underwriting and a much slower process when you're dealing with a bank. But on the private lending side, you assume that default will occur. The property is your primary concern, and your objective is to be much faster, and so you have a faster turnaround time. So a bank, their underwriting process is trying to eliminate the risk of default. Private lender, you just assume that it will happen. Banks, you're looking at in-depth underwriting to assess the situation, whereas as a private lender, you're usually looking mostly at the property. And then banks, of course, are much slower. One of the benefits of being in private lending is that it's much faster, and that's usually why borrowers, or one of the reasons that borrowers would be going to you in order to get financing. And so, something that you want to look at. An example of a deal that we did not too long ago was a $668,000 loan at 67% financing, 9% interest, a 3.5% lender fee. And the reason that we had such a high lender fee on this one was that we did see that there was a higher risk of the borrower defaulting and being in a situation they couldn't actually afford these payments. And so we, went to the investor and said, look, this is the situation. Are you interested in being the lender on this? There might be some challenges with them being able to afford the payments. And the lender was okay with it. The borrower, I think, had 2 different payments that they couldn't make. And so the lender just added it to the outstanding balance and capitalized that payment. And eventually, when the renewal came out, the lender said, you know what, I'm probably going to just look at getting paid out, and was paid out. And so they had a pretty good annualized return of 12.5%, and they only lent 67% of the property value. And so these types of deals, it's not like this type of deal specifically comes up all the time, but this is not an uncommon situation. Most deals, again, are somewhere in the 9, 10, or maybe up to 11% interest for a first mortgage, and then plus usually about more like a 1% lender fee. So that's something that you want to look at from a lender's perspective. Typically, the lender fee is important because if the borrower gets the mortgage and then 2 months later pays you out, and you didn't have a fee on it, and you just had an interest rate, now you got paid out and you did all that work to assess the deal, and then you only made 2 months of interest, and it probably wasn't worth your time. And so in general, it's usually important to charge a lender fee. The only people that don't charge lender fees usually are the those larger companies that just churn deals and it kind of all averages out. And as a borrower, if you're doing a flip, then you want something where it's an open mortgage with no lender fee, of course. So you're trying to do the exact opposite, where you want open and you want no fee. In general, though, if it's closed, then you can usually get lower fees because it's closed mortgage, which means there's a prepayment penalty to break the mortgage early. Whereas if it's open, then usually the lender will make sure that they charge some kind of fee to do this. And so who gets the lender fee? The lender gets the lender fee, and then the broker charges a broker fee, and the borrower pays for all of these things. And one quick question here, do you pay capital gains on the profit income? No, it's considered interest income when you're filing your taxes, which unfortunately, especially in company names, is charged at the highest tax bracket of about 50%. So it is passive income, interest income. And so that's something that you need to consider when you talk to your accountant. So a couple of examples of deals. First mortgages, bridge financing, or for self-employed borrowers or retirees or many other things. A typical loan might look like a $600,000 loan at 65% financing. It would probably be around a 9% rate and about a 1.5% lender fee. So about 10.5% APR for something like that. For a second mortgage, up to 80% financing to do a debt consolidation or pay off CRA debts or business loans, et cetera. A typical loan might be more like $150,000, maybe up to 75 or 80% loan to value, and maybe a 12% rate and a 2% lender fee, something in that range. A short-term loan, this would be like what we call a hard money loan. These are generally riskier and often are unsecured, and so usually the loan amounts are much smaller. Sometimes these would be for business loans, for renovations on a flip, for a small JV. maybe for deposit loans, something like that. And for something like this, you might say that you would possibly look at a $20,000 loan might be a 25% interest rate and maybe a 2% lender fee. Sometimes you can see that those sometimes are higher or lower than that. Okay. Just a quick question here that somebody was asking. So if you lent $100,000, you get taxed 50% of the interest amount that you earn. So if you lent out $100,000 at 10% interest, then that means you made $10,000 in interest, and you'd be taxed 50% of the $10,000 in interest. So you'd be taxed $5,000 of the $10,000 that you made on the interest cost. So deposit loans, yeah, yeah, it's not that much money. So deposit loans are very common. I remember a client of mine needed a deposit loan, and she needed it quick. She was writing a quick offer and wanted to win her bid. We had an investor to fund the deal. It was a $60,000 loan. It was only for 2.5 weeks, and there's a $5,000 lender fee. And then so the lender made $5,000 for lending out $60,000 for just 2.5 weeks. So that was kind of an interesting deal. Myself personally, I've also done some deals that are similar to that. Flips. Harder to get financing on flips, and sometimes doing it in an operating company name with the residential lending can be very difficult. And so the rate isn't as important usually in a flip for the borrower, because you're in and out very quick. You know, a small flip on a condo might be a $310,000 loan, 65% loan to value, but this one might be a slightly higher rate and a slightly higher fee, because the property might not be in the greatest shape, and so the lender might charge a little bit more on that loan than they would for something different. And then development deals. So bank financing is getting a lot tighter. Private lenders can be a lot more flexible, and so these are good for lenders who are ex-developers or ex-builders. I do have a couple of ex-developers and ex-builders who now are just doing lending, and they understand the projects. They know what they need to do in order to take over the project and finish it. And so we do see that these can sometimes be a good fit for those individuals. And in those cases, it might be a bigger loan, but it might be you know, at 50% loan to value or a lower loan amount for land development. Usually something around the prime +4 to prime +5 is typically what you see for these types of loans, with a 1% or sometimes up to 2% lender fee. So the other option is if you don't want to do all the work of being the lender, because if you're going to be a private lender, typically what happens is a mortgage broker like myself would send you deals, and then you review them, see if you like them, say, yes, I want to do that deal. And then we prepare everything, send it to the lawyer's office. The borrower pays for both your legal fees and their own legal fees to get the deal done. So you as the lender don't pay anything. But you're still the one that's signing off and saying, yes, I want to do that deal. No, I don't want to do that deal, having questions back and forth with the broker. And so another option is to invest in a MIC. So what happens with a MIC is the money comes in and it goes into a pool of funds. Then the files are underwritten, and then the money is lent out to a number of properties, and then a return comes back and the money comes back from all those borrowers on those properties back into the MIC, and then the MIC then pays out a return out to the investors. So basically, investors put money into the MIC underwrites and approves all the loans based on their set parameters, and then they lend out the money. The borrowers are paying the money back plus interest back to the MIC, and then the MIC pays a return, and usually in the form of dividends back out to the investors. So there's this is a common structure, and this is typically what the MICs are doing. And the benefit of working with a MIC is that you're basically being a small part of a bigger deal. So you can invest in much larger loans if you want. You're basically in a situation where you are going to be a small share owner of a larger MIC, and if one deal goes sideways, it doesn't affect your numbers as much because it doesn't impact you. And so, yes, Jeremy, anybody can set up a MIC. As long as you go through all the BCFSA required guidelines, and you do have to have somebody be a registered mortgage broker in order to do that. So there are some requirements in order to do that. You also have to make sure that you check out the BCSC, so BC Securities Commission. You need to check out all of their rules and regulations. Generally, the cost of setting up a MIC is about $100,000. It's not cheap. You have to come up with an offering memorandum and a number of other things if you're planning on raising capital. The other thing too that's a bit complicated if you want to be starting up a MIC is that you have to set up or be an exempt market dealer. So you have to be either setting up a relationship with an exempt market dealer to raise capital for you, and then it usually costs you money to do that because they can raise capital for other people, and that's how they get paid. Or you have to become one yourself. And yes, Paisley, I'll be getting to that shortly. All these lending methods can be done with TFSA. It's very uncommon because usually people don't have enough money in TFSAs, but you can use your TFSAs to do this. So one of the things to look at is diversifying. A lot of our clients are real estate investors, and a lot of them have a lot of money in the real estate market itself. But there's a lot of different ways that you can get into this and compare. So if you're looking at things here, if you're looking at the qualifications, to buy real estate, you do have to qualify. But to do private lending, to invest in a MIC or to buy stocks, there is no qualification. You have to get a mortgage. And we all know how much of a pain in the butt getting a mortgage is. The average return on investment, however, with purchasing real estate often can be much higher because you're leveraging the asset. And so the overall return can be much higher. I would say that maybe today, a lot of the deals that I've been doing analysis on are probably closer to about anywhere from 15 to 20% return on investment with the current market conditions. But in general, it's still usually higher than private lending, investing in a MIC, or buying stocks. On the cash flow side, purchasing real estate usually has the lowest return out of all of these because most of the return by buying real estate is usually not from the cash flow. It's from the mortgage pay down and from the appreciation aspect. Whereas in private lending and investing in a MIC, a lot of your return comes from cash flow or MICs. With stocks, you do get some cash flow because depending on what kind of stocks you're buying, you may be investing in stocks that have dividends, and maybe those stocks pay out a 3 to 6% dividend. So it's possible that a stock could be generating a large dividend. It's not common that most stocks would generate a dividend of 3 to 6%, although they obviously do exist. Purchasing real estate, it doesn't have to be 5 years, but typically we do recommend that you're buying real estate, you should be in it for the long haul. So usually the term should be more like 5 years. Private lending, it's very common to do 1 year. A MIC often is an investment where you're planning on keeping the money for at least 1 year. And sometimes depending on the MIC, you do have to keep the money in for at least a year. So you need to make sure that you read all their regulations and guidelines. And stocks, 1 minute to one lifetime. You can, they're very, very flexible. And obviously one of the benefits to stocks is their liquidity and how long you can, you can hold those for. If we look at the payout frequency for purchasing real estate, typically you're getting paid monthly cash flow. And then upon the refinance or sale, you're again getting a payout. In private lending, you're typically receiving the money monthly. Very, very frequently, it's monthly. Every once in a while, you'll get paid out quarterly or annually, but those are infrequent. So for the most part, it's usually that you're lending out the money and then you get paid a monthly amount. With a MIC, sometimes they do have monthly payouts, but most commonly it's more of a quarterly or sometimes an annual dividend payout. So that's a little bit different. On the volatility and risk, this really depends. Volatility in real estate I'd probably say it's about medium. It really comes down to what's happening with the real estate values in the real estate market. In private lending, it's low to medium, and especially if you're doing low risk lending. Investing in a MIC is considered fairly low risk because your money is getting spread out between a number of different investments. And then stocks, I would say that the volatility is much higher. And so I've rated that as a bit higher on the volatility and risk, especially if you look at stock market, the values and prices go up and down every day. On the flip side, liquidity in real estate is the lowest out of all of these. Private lending is medium. A MIC is also medium, but it depends on the restrictions that the MIC might have. And then stocks, very high liquidity, and that's one of the benefits of stocks. And then RSP eligible. So purchasing real estate, no. I mean, if you can get a little bit creative on buying real estate with an RSP, but it's almost impossible, and you still effectively have to use debt in order to buy real estate. But if you're investing as a private lender, you can actually self-direct your RSPs and invest and lend out your money through Canadian Western Trust or one of the other trust companies. And a MIC, usually they're RSP eligible, so you can invest in your money there. And then typically most stocks are also RSP eligible. And then with getting started and getting into investing in a MIC, I do have a lot of recommendations. If anybody wants to email me, I'm happy to make introductions on investing in a MIC, and my email address is kyle@greenmortgageteam.ca, and happy to do an intro, introduce you to some people that have funds that could be a good fit for you to invest in. When you start to get started and look at what do you do next, I will say that this method here that I'm going to talk about is a little less common right now because people have seen that the interest cost has risen and that the spread is less. But if you do have a home that's totally paid off, or you do have equity in your home, and having a home that's paid off or getting close to being paid off, it doesn't really work for you. Other than the appreciation, there isn't really much of a gain. And so what a lot of our clients do is they look at getting a HELOC on their home. They get a readvanceable mortgage, which allows them to minimize their taxes, and then they also get to use it to invest at the same time. So the way this would work is, let's say that you had a place worth $500,000 and you had a $225,000 mortgage on it. What you could do is get a home equity line of credit for, in total, about $400,000. And what ended up happening is, as you pay down the mortgage, your line of credit limit will slowly increase, and it switches over. Now, the government just did very recently made a change where if you're financing more than 65% of the value of the property, even if you make payments on the mortgage, the line of credit limit will not increase until you've paid it down below 65% financing. So this is something that's very interesting. Now, if you do this on your residence, usually the mortgage on your home is usually not tax deductible, but any money you borrow to invest is. And so what people often do is they pay down their mortgage, they reborrow the money back out in the line of credit, and then they use that to invest. And whenever you borrow money to invest, the interest portion of the payments is tax deductible. So you can do this on your residence, you can do this on rental properties. It's more effective on your residence because you're switching money from being tax deductible to being non-tax deductible, or from non-tax deductible to being tax deductible. So you want to have that shift. You can do it on a rental property, however, as well. It's just that all of the money on the rental property is probably already tax deductible, and any money you borrow against it is also tax deductible. And so there's less of a benefit because you don't have debt that's different classification from the tax perspective. So normally, this is a better vehicle to use on your residence. But if you already have your residence paid off, or if you really just don't want to tap into the equity in your home, you can instead borrow against a rental property to do this exact method as well. Now, probably the reason that we're not seeing as many people do this is that you can invest at 10%, but borrowing money is not cheap today. And in fact, even 7.2 on a line of credit is a really good rate. Most banks are prime plus about 0.5%. So that would work out to be 7.7% as of today. There's a couple of lenders that we work with that are authorizing about prime plus 0. So that would be 7.2% for a line of credit. But most banks are prime plus 0.5. And so in the past, not too long ago, just 2 years ago, you used to be able to borrow money on your line of credit at prime plus about 0.5, which was about 2.95%. And then you could lend that out, and maybe you could invest it at 8%, and you basically create a spread between 2.95 and 8%, which is a spread of about 5%. Nowadays, the cost of borrowing is much higher, and the returns on investing aren't that much higher. And so the spread is a little bit smaller. And so in fact, I made a mathematical error on doing my PowerPoint today because that's 2.8% spread, not 3.8%. So just an important item here to look at is this, that the spread between cost of borrowing and investing has tightened. It doesn't make sense for everybody to be employing this strategy at this particular moment. And so that's something to look at. And Justin, it can be more difficult to get a HELOC type of product on a rental property. So it's usually easier to do it on a residence and harder to do it on a rental, but you can still get it on a rental with the right lender and the right qualifications. A couple of other things. If you are using RSPs to invest, then it must be self-directed through Olympia or Canadian Western Trust if you're going to be the lender. But if you're doing it with cash, There's no restrictions, and yes, even a TFSA can be used. But even just to look at it, a TFSA, usually people just don't have enough money in the TFSA to be able to use to invest into private mortgages. But you might want to see if there's any mix that are TFSA eligible, as a smaller amount that's in a TFSA could be a good fit. This is just an example of when we sign up a private lender. We usually get them to assess the type of lending area that they'd like to do, the loan type, the loan to value, the property types, loan sizes, and overall credit risk. And it gives you a bit of a range of the approximate rate of return that you can expect. That's what we use to onboard our investors. And then we have a private lending request form. So it's usually a one pager or one and a half pager that just goes through some of the details of the loan that we're requesting. And it gives you an idea of what options would be available, what our expected rate range, the risk tolerance that we see with that deal would look like. And so if you have a bunch of money sitting in RSPs and are doing nothing, or you're looking for a higher rate of return, then it may be time to look at getting your retirement strategy set into place, and maybe being a lender in private lending could be a good fit for you. Last but not least, I'll wrap up this webinar just by talking a little bit about something that I'm really excited to talk about. We've been slowly rolling out something called Atlas, and this is our new software that I've been developing for quite some time now. But what it does, it allows for us to underwrite a client file with no documents, with no credit inquiry, and it maps and shops it with the 32 lenders, and then we can generate a report for you within about 5 minutes of you filling in an online form to let you know how many lenders you qualify with. In the next little while here, probably in the next, I would say, 2 months or so, soon this version will be enhanced in a big way, and it'll actually show all the rates available with all these lenders as well. So we're going to be developing the software and continue to make it better. Our very first version is something that we're working on in-house, and it's something that we enter in internally to improve this process. But very soon, we're hoping that eventually at some point, you'll be able to fill in an online form, and it'll actually spit out all of your options and tell you, how many lenders you qualify with and what the rates are with all of those lenders. So we're very excited to be that, to have that option available. We launched it, I think, about 30 days ago, maybe last month. So it's a very, very cool system and cool product. And it takes a lot less time for us to underwrite a file, and it takes a lot less time for you to get the quick answers that you're looking for too, which is nice. And this is something that internally we started off with just having a spreadsheet, and our spreadsheet version looks like this. And yes, it looks like a hot mess, but it gives us the debt servicing with all of the lenders and all of the lenders' different products. And so it gives us a really, really good view of everything that's happening in the marketplace. As of right now, this product is just doing it for major banks and A lenders in that space. Eventually, we're going to be rolling that out to private lenders, and it's just a bit different on the private lender side. So we might end up eventually making it more of a bidding process for private lenders that are looking to place loans, where private lenders could bid on deals. So we'll see where that takes us. If you want to learn more about this, we do have an investor survival guide and a private lending package available. So make sure you email us or check out our website. We do webinars on the first Wednesday of every month. So we do have upcoming webinars, of course. I don't think we've announced the topic of our next webinar yet, but that will be the first Wednesday of November. And if you have any questions, you can feel free to book a consult with us today. Obviously, you can contact us and reach out to us for more information. What I'll do now is I'll go into the Q&A, and then I'll go back into the chat just to answer some of the questions that people may have had for us during the conversation. So I think Justin was just asking if we can do private lending on rental properties or non-principal residence properties, and the answer is yes. Also, if you are looking at maybe doing the Smith maneuver, I think that was another question of yours, Justin, and then you can also do the Smith maneuver on rental properties as well. It's just that there's less lenders that like to do that, and it's a little bit harder to qualify for too. I also have an anonymous question here. So last year we bought an apartment in Kitts for 1.1 million. It's an investment property, and we used a private lender. Our payments, interest only, went from 28 to 38 grand, and we sold the home and made a healthy profit. Now we have no mortgage plus a considerable amount of cash in the bank, as well as 3 to 4 other liquidable properties. And if you worked in the film industry, but due to COVID, or your income has been limited. So although you have a lot of cash and real estate, you're frustrated with the limitations to borrow again. Yeah, so very difficult. So high level, these are the type of circumstances that private lenders can help a lot with, is when your income is being affected by outside sources. Now, it isn't impossible to get lending through different banks. This actually would be a really good case study. I'd love to see what happens if we ran something like this in the scenario through Atlas, because you might be a good fit for a net worth program out there in the marketplace. There are some lenders that will lend based more on the net worth that you have as an individual. I will say that most of the lenders' programs for net worth, however, do not look at real estate net worth. They look at liquid net worth. And so if you have a large liquid asset base, then a lot of the time what they look at is you say, okay, your income can qualify you for this much, and then you want to get a loan of this much, and so you need that much in liquid assets. So if your income qualifies you for a $400,000 mortgage, and you're looking for $1 million, then they would say, well, you need at least $600,000 of eligible liquid assets. And so this is something that that may be available to you. There are a small handful of lenders, however, that will consider real estate assets when determining how much you qualify for too. So I'd be happy to discuss this with you one-on-one and go into some more details if you want to see if that's an option. And of course, you could also try using Atlas to see if that's something that could be a good fit. I'm just going to go into the chat now because I think that's all the Q&A. Let's just see what questions we have here. I think I did miss some as I was in the middle of the presentation. Okay, so let's take a look here. Okay, so I think I was caught up to here. To invest in a mix, so hey, Christoph, to invest in a mix, do you buy shares in the company and get paid out dividends? Or do you simply invest in them for a period of time in a certain percentage? It actually depends on the MIC, but in many cases you do end up buying shares and then they pay out dividends. So it really depends on the circumstance. Usually, what happens though is you're investing into a fund, not the actual company itself, but one of their funds that they manage, and that's what you effectively are buying shares in. So that's. Yeah, I would let the MIC actually explain exactly how they structure that, but you're effectively buying shares in the company, but only in the fund that is investing, not the actual company that's lending out the money and making additional funding or income in fees in other areas. They usually do charge a management fee, and usually that management fee goes to the head operating company, whereas the funds are a separate entity that you're investing into. Let's see here. Oh, yes, Sherry. I have not quite fully recovered from my concussion. Yeah, I know it's a silly math there. I had to change the numbers on the on that slide there where it was higher. Every time I've done that slide in the last year or two, I keep having to get the rate of return get smaller and smaller and smaller. It used to be over 5%, and now it's harder. Okay, so Mark, good question. If you have a sizable RSP and want to purchase a rental property, can I transfer cash to Olympia and issue a private mortgage myself? If that's not possible, can you find another investor in a similar situation, have a private loan on our respective real estate investments? Yes. So they call it an RSP swap. And so when I was kind of hinting that technically you can't really buy real estate through your RSP, but there is a bit of a way or workaround, you've basically described it here. And so if you find somebody else that has money in an RSP, then you can do an RSP swap. And so basically you lend your money to them, they lend their money to you. You guys agree that whatever the rate of return will be on that RSP, and you can do that. So it is possible. Michael asked, what is the scope of our private lending sources? Does it include Ontario? So we do have a lot of private lenders that we work with in Ontario. So a lot of our individual investors tend to be mostly BC based, whereas a lot of the more institutional lenders are both BC and Ontario. But we do have people in both, and we have borrowers and lenders in both areas. More, of course, that would be in BC. And then Carolina is just asking to repeat my email address. So that's Kyle@greenmortgageteam.ca. And if anybody was looking for an introduction to somebody to discuss a MIC, then feel free to send me an email, and I'm happy to do an introduction with somebody that I trust, so you can discuss that in more detail. Jeremy asks, are most of these strategies available for buying an existing business? Yes, so private lending can work. The key is if the business is not real estate backed, then it's not used as a security or collateral. And so you'd have to use a different property with equity in it to be using as collateral for a private mortgage. A private mortgage is a real estate backed investment, not a business backed investment. So everything that we talked about will be backed by some kind of real estate. So either you're buying a business that has a location and owns real estate, and you can get a loan on that. If it does not, then you'd have to secure the private loan against a different property. And then Shan asks, are there debt servicing requirements or limits for this? Generally not. So usually a private lender is looking more at the exit strategy and how are you going to get out of this. There are circumstances, however, where if you're doing mostly in the commercial side of things, and especially bigger loans with institutional mix, they still like to see that at least the debt servicing is about break even. They don't generally like to lend on commercial assets where you're going to be negative every single month unless the exit strategy is very, very clear. So it just really depends on the situation. And then Patrick asks, with private lending, the interest-only payments are attractive. However, do the excessive fees listed as conditions for defaults make private lending too risky? So it depends on whether you're on the borrowing side or the lending side, to be frank. Usually if you're borrowing money, you always want to try and get bank money first because it's almost always cheaper. And so you always push that angle. But in some cases, the deal might be really hard to finance through a bank. And in general, those are often the deals that can have a bit more juice in it on the return on investment. So it really depends on the situation and circumstances. But yes, the interest only payments just make it look not as bad as getting a mortgage through a bank at a lower interest rate that's amortized. It's not a reason in itself to go with that option if you had the choice. Usually people are only using private lenders and they don't have a choice. Thanks, James and Greg. Appreciate you guys coming out. Thank you. Jacob has a question. So with regards to private lending, is it a big difference in rates or qualifications when lending for residential versus commercial? Yes and no. In general, sometimes the lenders do want to see some kind of debt servicing in the commercial side of things. And in general, commercial assets are a little less liquid. And so usually there's a little less flexibility and a little less wiggle room on those loans. So you're going to find in general, the loan to value is about 5% to maybe 10% less, depending on the asset class. Commercial assets in smaller towns, very hard to get financing on because smaller towns are less liquid in nature. And then commercial assets are even less liquid too. So you'll find that in general, it's harder to get financing on commercial than it is on residential. It depends on the asset. Multifamily is a lot easier in general, but in industrial in a small town, or especially something like retail or office space, which is kind of struggling a little bit right now, you're going to find that it's going to be harder to get commercial lending against those. Mark asks, as the broker for private lending, if a borrower defaults on a first mortgage, are you involved in the liquidation process? So yes and no. So in a default situation, we always work with the borrower to try to figure out and make sure that they can generate payment. It's important for us to stay in the middle in this process because the borrower and ourselves usually have a relationship. We make sure that before we place a deal with a private lender that they can make sure that they pay out of it and have an exit strategy to get out of it. So we don't want to just fund the mortgage and then walk away and never touch it again. However, if things hit the fan and they haven't paid for 3 months and we've been following up and you've been following up and nothing's happening, eventually at some point you're just going to need to go through the standard legal process, which is getting a lawyer involved. And at that point, usually we're handing the reins over to a lawyer to instigate that. And anything that I've actually done myself where I was representing both the borrower and the lender, we have not had any foreclosures. We've had 2 different clients that have had a couple of late payments, and we were always able to catch it up, and the borrower always made the lender whole in all those circumstances. But at the end of the day, it's not common. Usually if I'm representing both the borrower and the lender, I really don't like the high risk stuff. I don't want to be in the middle of a deal going sideways. It's a lot of administration and a lot of time cost for us to be doing that type of deal. Where if it's a higher risk deal, I'll usually just represent the borrower only and then shop it around to other lenders that I don't represent and see if they'll pick up the deal, because then it's up to them to decide if they like it or not. Let's see here. Just seeing if there's any other questions. Keith, nice to see you. Yeah, and of course, if you want to reach out, please do. And yes, Monica, looking forward to the brunch and learn on the 22nd. I'll be sending you an email shortly on that too. I didn't want to inundate everybody with too many messages. So thanks everyone. Really good to see a lot of familiar faces. And if anybody wants to ask any questions or clarify anything, then please just reach out. And otherwise, have a great evening, and we'll talk to you guys soon. Thanks a lot.